All right, so we're going to continue with disposition effect. We should be able to cover all of this disposition effect in just one session. So after the disposition effect, we'll start talking about cap M. And now our focus is obviously not on cap M. Our focus would be on the pitfalls of cap M, why it doesn't work. All right, so let's finish up with the disposition effect. Okay, let's see, how do I slide? All right, so just once again, some definitions. As we mentioned last time, suppose you purchase some shares at $80 per share, and then now if the price goes up and you sell the shares, you're making a profit, and you decide to sell some of those shares to realize the profit. We say the percentage gains of gains realized, PGR, is the percentage of shares that you have sold in a gain. The actual magnitude of gain is not a concern here. What we want to investigate is how much of the shares that have earned money you have realized. We have a similar ratio for losses. So the percentage of losses realized, PRR, is the percentage of shares that you sold at a loss. Now, the issue we talked about last time is this diagram. This is the data, as we mentioned last time, from US, a large discount brokerage. Now, what is a discount brokerage? So a discount brokerage is basically, as what is named in bright, a brokerage that charges relatively low fees. So in the US, you have very high-end brokerages that tailor to rich private clients. You have some sort of mainstream brokerage, and you have discount brokerage. So this would be the type which advertise that they have very low fees, which also means they pretty much provide no other service other than trading for you. This diagram is interesting because you can see that throughout a year, so this is the averages from multiple years, throughout a year, most of the time, this realization in gains outnumbers the realization in losses, except in December. Now, this itself is not necessarily a problem, since people obviously want to sell at a gain, no one wants to sell at a loss. So the question is whether this is rational. It can be rational because that's what selling at a gain is what people want. Selling at a loss is not. However, as we say last time, typically, investment advice would be that you should cut your losses if the stock is going down over a certain threshold. So if that's happening, you shouldn't be expecting this ratio strong, especially not during years where the stock market is going down. And what's up with this particular low ratio in December? Now, as we say last time, this is due to tax. So this is very rational. This is tax. Because in US, you can, if you realize your stock market losses, you can use it to deduct taxes. So that's a strong incentive to do that. But otherwise, people really want to sell at a gain and not at a loss. And as we have seen last time, this is a diagram plot from the same data. There are reasons to suspect that investors do not invest wisely. Now, these are small investors. We're not talking about Goldman Sachs. We're talking about small investors, mom and pop, using discount brokerage to trade with their own money. And the evidence suggests that when they buy a stock, the stock price goes down subsequently on average, and then when they sell a stock price goes up subsequently on average, suggesting that they're not timing the market right. So there are reasons to suspect they're not completely rational. So investors have a tendency to hold stocks that have lost value, and this is called the disposition effect. Now, what we're going to do next is to think about what are the reasons why investors want to hold losing stocks, despite the fact that it's usually not a good idea. We'll see evidence that why this is not a good idea later on when we talk about the pitfalls of CAPM. Okay, so possible reasons behind disposition effect. Now, tax, as we already mentioned, one possible reason is tax deduction. So one possible reason why you want to hold losing stock is maybe you are timing it for tax return. You are keeping your losses until a point where you have to report your taxes, you realize your losses, then you report your tax. However, as we have seen in the diagram, even in December, the number is pretty close to zero. Pretty close to 1. That is, loss realized versus gain realized is pretty close. You're not really seeing a lot of realization of losses, even at the end of the year. So that is not strong enough to explain away the effect. Believe in mean reversion. Why do you hold losing stock? Well, that's because you believe losing stock is going to come back up, right? What goes down must come back up. That would be the belief of mean reversion. Empirically, there is no reason to believe in mean reversion. We'll see, as I said, we'll see in the next part of the lecture. Generally, the stock market has what we call momentum. What has been going down tends to keep going down. So there's no reason to believe in mean reversion. Definitely not in the short run. Finally, we're going to investigate whether prospect theory can explain mean reversion. Here, I'm going to present both evidence for and against, using prospect theory as an explanation. So, let's start with a simple way. The simple explanation is actually what Terence Odin used in his paper, to explain the effect. All right, so here goes the story. So this is a standard prospect theory diagram. So first, the loss side is steeper than the gain side, right? So you lose more utility than the amount you gain for equivalent gain. So that's loss aversion. Second, you have what we call diminishing sensitivity. A lot of money doesn't make you too happy. A lot of losses doesn't make you too sad, right? Third, probability weighting. You can't see it here, so we'll keep that away for now. So the story actually is very simple. Let's say you start from here. You buy a stock. The stock goes up in value. You are in the gain domain. You see that the utility function is concave, which means you have become risk averse. So you sell your stocks, right? So you realize your gain. If you lose money, this part is convex. So you have become more risk seeking. So you hold your stock. So that's the story Terence Odin gave in his paper, right? People buy some stock, it gains in value, they become more risk averse, so they have to sell the stock because stock is risky. When the stock loses in value, they become more risk seeking, and if they have been willing to buy stocks to begin with, they become more risk seeking, so they are even more willing to hold a stock. So that's the story Terence Odin gave in his paper. So it sounds very intuitive. But it's only plausible if you look at it at the surface. especially if you just look at diagram, it looks reasonable. But once you think about it more carefully, you will see that this is problematic. Now, why is it problematic? Okay, so risk averse, willing to buy, risk seeking, willing to sell, risk seeking, willing to buy. Right. So what you get is something similar to the demand for stock is will be somewhat similar to this diagram. So okay. So this is a current. So the horizontal axis is stock price. The vertical axis is the demand for shares. Now, okay. So what happens is this: the 0 point. The 0 point is the point of purchase, right? Point of purchase, and if the stock price goes up by a bit, there's a sudden drop in demand for stock because you became more risk averse, right? But then it starts to go back up. The reason is you have become richer, right? As you get richer, then you have a bigger appetite for buying stock. This is, as we mentioned before, this is the house money effect. You have gain in money, and in general, people are more willing to gamble away gains in money because it feels like, oh, it's extra cash that I've earned. So I didn't expect these. So I'm more willing to invest them in a risky investment. Okay, so this is the house money effect. They have earned money and they're willing to use those money for investment. And this part reflects the risk-seeking behavior. As the stock price goes down, people become more and more risk-seeking, and then they want to hold more and more stocks. Right. So this would be what you would expect from a straight interpretation of the prospect theory diagram. Now let's think about why this is problematic. Okay, so I've talked about all these. Okay. All right, the problem is we haven't actually used loss aversion at all. All we have been using really is diminishing sensitivity, right? We are saying the concavity would make you want to sell stocks. The convexity would make you want to buy stocks. We haven't actually made use of loss aversion. What does loss aversion imply about buying stocks? Actually, loss aversion implies that people are very, very risk averse initially. That is, when you decide whether or not to buy any stock at all, you are actually very risk averse because you don't want losing money. So you're very reluctant to buy stocks due to the chance of losing money. Right? This is something that Terence Odean seems to have omitted when he tried to explain why there's a disposition effect. Now, think about it. Let's say you buy some stocks, you might earn money or you might lose money, right? So I'm just for demonstration, these 2 points look roughly equal, but you can imagine that the gain is slightly larger than the loss. So it just looks it is, but it's just on the screen it looks quite close. All right. If you remember from your microeconomics course, the way to draw expected utility and expected value is to use a line to join the possible realizations, right? The simplest case is like this one. Binary outcomes, either gain or losses. Expected utility lies on the dotted line. You should have learned that in microeconomics. Expected utility is simply an average of all possible utility realizations. So it's basically lying on a straight line. Okay, so that's the expected utility from buying stocks. The green dot is the utility of doing nothing. If you do nothing, you're simply staying at the reference point of doing nothing. All right. Now take a look. Already you can see the problem, right? You can see the problem is that you need a really high chance of gain in order for this expected utility to be above the green dot. Now, at this point, it's below, right? At this point, it's below. This is about a 50-50% chance of gaining and losing, and it's below. You would need quite a substantial gain in order for the white dot to be above the green dot, because the vertical axis is utility, and you need a positive expected utility over doing nothing for the investor to be willing to buy the stock. Now the question is, empirically, is the expected utility likely to be above the utility of doing nothing? All right. So, Barbaros and Strong, 2008, also a Journal of Finance article, What Drives the Disposition Effect, and Analysis of a Long-Standing Preference-Based Explanation. So this paper is exactly examining this problem, is that if you really treat this story seriously and try to compute the utility carefully based on actual stock return, will people actually buy stocks? There is a good chance that they won't, because if you only have like a slight chance of gain over losses in the stock market, now once again, obviously this as we talked about in the first class, this obviously depends on the duration of trade. If you're talking about 20-year investment, you almost never lose money, right? But then, since empirically, especially in Terence O'Dean's data, small investors typically trade very frequently. Very few small investors hold a brokerage account to hold stocks for 20 years. So most of them trade very frequently. So the question is, if that's the case, if they trade very frequently, will they actually get an expected utility that is higher than doing nothing? So that's what they did. So what they did was they ran simulations with U.S. stock data. So once again, you can use the U.S. stock data. You can compute the distribution of possible stock returns, just like what we talked about in the first class. So you can run simulations. All right. So what have they found? All right. So this diagram plots for different expected return from the stock market, right? 3% return, 4% return, up to 13% return annually. And the horizontal axis is the number of trading periods within the year. So do they trade twice a year, 4 times a year, or once a month, and so on. Now, the first thing you notice is when the stock return is low, it's actually very unlikely that people want to buy stocks. If it's just a 3%, think about it, it makes a lot of sense. If it's just a 3% return, most people would probably opt for buying bonds or even just certified deposit, right? It's not worth the risk of investing in the stock market if you only have 3% return. As the return gets higher, you see that people start trading. You can see that for very low return, you need a very long trading period to overcome the risk. This is what we talked about in the first class. If you invest over a long period, you aggregate the return, the risk is relatively small. As the return gets higher, people will start trading more and more frequently because the return is high. Okay, so that's the first thing we observe is that, well, stock market return has to be high enough for people to be willing to buy stocks under a prospect theory utility. Now, this is also true of expected utility. It's just that the threshold is not as high. Prospect theory means that people are very risk averse, so you need quite a high return to induce them to buy. All right, so that solves the first problem. But now here's the second problem: is that if the return is in fact so high, okay. All right. Now the second problem: if the return is in fact so high, so on average, you gain money, right? So the stock market performs very well. On average, you earn money. So most of the time you'll be here, gaining. So you buy here. Most of the time you end up gaining. All right. So after you gain money, what's your decision process? Given that you have prospect theory utility, you face once again some chance of earning more money further. So the stock price might go up further, or the stock price might go back down. Once again, you can draw the expected utility with a straight line in between the two possible points. So now here's the problem. If the stock return is high enough to overcome the initial reluctance to buy stock due to loss aversion, it's also likely to be high enough to overcome the risk aversion in the gain domain. You can see that from a diagram, the concavity is not very strong. So you can see that people are actually not very risk averse in the gain domain, especially compared to loss aversion. You can imagine that this kink is really just one version of a very concave line. This is very concave, right? This is very concave. This is not very concave in gain domain. So if the stock is performing so well such that you don't worry about losing money, then this tiny amount of risk aversion is not going to make you into selling your stocks. So that's the problem with using loss aversion using prospect theory to explain disposition effect, is that if they're willing to buy stock at all, then when the stock gains in value, despite the fact that they are risk averse, they would still want to hold a stock because the stock is doing so well, right? Realistically, we are all risk averse, right? People buy insurance, right? We avoid unnecessary risk. So in some sense, everyone is risk averse. Yet that doesn't stop us from buying stocks. So the return in stocks generally is too high to get disposition effect. So if stock return is as high as 10% or above, that would be sufficient to induce investors to buy stocks despite the fact that they are loss averse. They hate losing money. But the stock return is 10% per year on average, so they're willing to buy. But if they do, then, and assuming there are 2 trading periods per year, they would actually never sell the stock. They never sell the stock. Never. So the reason why this paper focuses on T equals to 2 is that on average, in Terence O'Dean's data, small investors trade like twice a year. They trade twice a year. So that's why they focus on this part. So once again, the story is very, if you think about it, once you heard about it, it's actually very reasonable. So you really don't like losing money. So to convince you to buy stocks, stock return must be high. But if stock return is so high and then you earn more money, then you actually manage to earn money, why would you sell? It's doing so well. You want to keep it, right? So that's the problem. So how do you does that mean prospect theory cannot explain this behavior? Does that mean that prospect theory cannot explain this behavior? It still can, but you have to think more carefully how the investor decision process looks like in their mind, right? Okay, so I've already mentioned all that. Loss aversion, very risk averse initially, so stock return has to be very high to attract investment. So if that's the case, then the small amount of risk aversion at the gain domain would not be sufficient to force investors to sell their stocks after a gain. So they actually might want to invest more because there's the house money effect. Right. So if we still want to use prospect theory to explain this behavior that investors don't want to sell stock after a gain, you need the gain loss utility to be over only realized net profit, not profit on paper. So the idea is the investor would experience gains and losses once they sell the stocks. As long as they hold them, it's not a gain, nor a loss, right? Now in Cantonese, we have a saying for that: 有賭未為輸. You haven't as long as you are still playing, you haven't lose. So this is the idea. Holding stocks in your account does not count as gain or losses, despite the value might have changed. Once you sell, then the gain loss realized, then you feel the gain or the loss. Okay. Now, still, you need some sort of utility for consumer to decide the investors to decide how much to buy, and this would just be an initial normal non-gain loss utility, like CRRA, right? So investors just invest according to a normal expected utility. The only difference is at the point of selling, they would experience an additional component of gain and losses. Okay, when you buy, you're simply deciding on a normal expected utility, risk averse, but just based on the absolute wealth. When you sell, besides the absolute wealth, you also care about the gain and losses. Okay, so now with that, then prospect theory can once again help us to explain the disposition effect. First, if the stock has gone up in value, and you think about it, should I sell? If I do sell, not only do I earn more money, do I realize the wealth that I have, I also realize a gain, which is an additional shot of happiness that I would get. So that gives me more incentive to sell. On the other hand, if there is a loss, then when I think about what I should sell, I am discouraged by the additional sense of loss that I would feel if I do sell. But if I don't sell, then all I am suffering is the drop in absolute wealth. So this would allow the model to explain the disposition effect. But so in some sense, you might say it's kind of cheating your way out, right? It doesn't. So the gain loss utility is too loss averse for investors to buy stocks and sell later. So you say, well, the gain loss utility doesn't affect you when you buy stocks. It only affects you when you sell stocks. So now, this is this is obviously very theoretical when the authors think about this problem. Towards the end of this part, there's a relatively new paper that uses neuroscience to show that there might be, in fact, some credibility to this story. So we'll see that at the end, at the very last slide. First, some laboratory evidence. So once again, what we had just now is simply theoretical models plus simulated stock price. Okay, this is a laboratory experiment. Once again, laboratory experiments typically are undergraduates sitting in a computer lab playing games on a computer. Okay, so let me describe the setting. So it's a controlled experiment. Subject decides whether to buy or sell 6 assets for 14 periods. They are trading against a computer. In this case, it's not an actual market. They're trading against a computer. In fact, they're actually trading against a predetermined path of stock movement. The subjects were not told of the movement. I believe they have something like 3 periods to observe the initial movement before they start trading, but the movement is actually predetermined by the experimenters. Okay, so there's a predetermined probability of moving up. All right, so experiment 1, free trading. And experiment 2, automatical forced selling after every period. So, if you're part of experiment 1, you are allowed to decide whether you want to buy or sell in each period. Now, experiment 2, what automatic forced sell after the period means that at each period, the system automatically liquidates all your stock, giving you back your money. You are, however, allowed to buy back whatever you want, and there is no transaction cost, which is to say, theoretically, these two are identical, because you are allowed to buy back what you want in the second experiment, and you are allowed to sell whatever you want in the first experiment. So say for the transaction cost of clicking your mouse button, they are equivalent, theoretically. But behavioral-wise, they are not equivalent. So this is the plot of cumulative distribution of the disposition coefficient. Now, the disposition coefficient in this experiment is as defined as follows: the number of shares sold in gain minus the number of shares sold in a loss over the overall shares sold. Right? Okay. So a disposition coefficient of 1. What does that mean? That means all your shares sold are gains. Right? That's why you get a 1. If it's 0, then it's basically mean that you have no disposition effect because gain and losses are roughly the same. Right? Because in this, once again, the assets have predetermined probably going up, so some assets go up, some assets go down, predetermined. So you should see people selling the stocks they're gaining. You should see people keeping the stocks they're gaining, selling the stocks they're losing in their portfolio initially. Okay, so you want to, as you see more and more realizations of the stock movement, you realize some stocks are actually doing better than the others. So you sell the stock that are not doing good, you keep the stock that are doing well. So 0 would be no disposition effect. In this experiment, it would be a bit strange to see why it would be -1. The one difference between these experiments and an actual trading world is if you hold the assets towards the end, the very end, usually you still earn money. That is, at the very end, you're still holding the stocks. You'll be holding the winning stocks, so you'll still be paid. Well, whereas in the real world, very often you would need to sell stocks to realize gain. Right? So that's why there's no reason why you should sell. You should there's no okay. What I should say is, there's simply no name for what this behavior would be, right? because in this experiment, yeah, you can do it. You can do it. There's no reason why you can't do it. Okay. All right. So it's this is, I think, it's a solid dot. The solid dots are subjects in experiment 1, and these triangles are subjects in experiment 2. So this is a cumulative distribution. So that means the steeper the line goes up, that means there are more people in that area, right? That's how this cumulative distribution works. Steeper means more people in the area. So you can see that there is a relatively steep part at the very end for experiment 1. That is, in free trading, a lot of people only sell at a gain and never sell at a loss. Now, since the assets have predetermined probability of moving up and down, this is not rational. As you observe that the stock has been moving down, in this experiment, the subjects do not know which asset is going to go up or down, but they were told that the assets are actually have predetermined probability. So this was told to them. So they know that the assets have predetermined probability. They just don't know which one is the good ones and which one are the bad ones. They do know that the good ones are going to be good, the bad ones are going to be bad. So this they do know. So based on the information that I told you, so think about it. Let's say you are all in this experiment. I told you that you're going to observe there are going to be 6 assets. The good ones are always the good ones. The bad ones are always going to be the bad ones. There's some randomness, but the good ones are never going to turn into the bad ones. So you have 14 periods plus, I believe, 3 observatory periods. So you have like over a dozen periods you can observe the stock price movement. So given that I've already told you the good ones are going to be good ones and the bad ones are going to be bad ones, eventually you should see quite a clear pattern, which one you should buy and which one you should sell. There's absolutely no reason that you should not sell at all. You should sell the bad ones. All right, so for the group with for selling, the steepest part is the area close to 0, which means that people are buying and selling at roughly equal weight. So it would interpret it as no disposition effect. All right. Now, one thing I want to mention: this paper was published in Journal of Economic Behavior and Organization. The author is actually quite famous. Colin Camara is a very famous experimental economist in Caltech. So this is a relatively low quality publication by him. Like, he usually publishes in places like Science rather than JEBO. It's not a bad journal, it's just not a top journal. Now, one of the reasons you can imagine is this experiment the result is not very clean, right? Despite we saying that there's the steepest part is for the experiment 1 is here, so there's disposition effect. This is still like only 20% of the subject, right? Which means 80% of the subjects are not doing this, right? So it's not very strong evidence, and the slope is quite gentle. So prospect theory offer not a lot of explanation of what governs these people's behavior. Is it that only 20% of people have strong gain-loss utility, or what does it mean? So the evidence is not very strong. All right, now here's some laboratory evidence that is against prospect theory. That is, this experiment wants to say that prospect theory is not the reason behind disposition effect. So the setup is actually very similar to the previous experiment. Now, the question at hand is there a relationship between the gain realized and the loss realized? Remember, in prospect theory, the story is If you earn money, you become more risk averse, so you want to sell your stocks. Or if you use the later on the realization story, if you sell, if the stock goes up in value, and if you sell, you get an extra boost of happiness. And on the other hand, at the loss domain, if you lose in the original story, if you lose money, you become more risk-seeking, so you're willing to keep the stocks or even buy more. In the realization story, if the stock loses value and you sell them, you're going to experience an additional pain due to gain loss utility, so you're reluctant to sell. So either way, the story gives you some symmetric prediction. If you are reluctant to sell at a loss, you should be willing to sell again. When you have one, you have the other, because that's how the prospect theory utility looks like. So this is what this experiment tests. Is there actually that relationship? For when someone is reluctant to sell at a loss, are they more willing to sell at a gain? Prospect theory say yes. Now let's see the experimental evidence. Right, so I've explained this. Okay, so first, overall, you have percentage gain realized is higher than the percentage loss realized. So each dot is a subject. Right? And horizontal axis is percentage loss realized, vertical axis is percentage gain realized, and if you're above the 45-degree line, that means your gain realized is higher than the loss realized. So it's very hard to see it just like on this diagram, because the black dots all becomes one big mess. But there are more black dots than white dots. Okay? So people on average, people are more likely to realize gains than losses. Okay, that's good. That's the disposition effect. Now, what's not so good? What's not so good is you are actually not seeing the subjects selling too soon being the same subjects as for those who are holding too long. Right, how to see this? Okay, so now if the prospect theory story is true, you should see that for subjects who always sell at a gain, they should also not be selling at a loss. That's the story. Remember, when you gain in value, you want to sell. When the stock goes down, you do not want to sell. That's the story. But what we're seeing is this: among the subjects who always sell the gain, basically always sell the gain, the percentage loss realized for them is all over the place. It's almost like it's random, right? It's almost like it's uniform distributed. That is, even though they're very reluctant to sell even though they're very willing to sell the gain, they're not reluctant to sell at a loss. They're not reluctant to sell at a loss. Similarly, for subjects who are unwilling to sell at a loss, you can see that they're not particularly willing to sell at a gain. The dots are also look like quite evenly distributed. So this is evidence against using prospect theory as an explanation for disposition effect, because gain loss utility would predict that those who are willing to sell at a gain would also be unwilling to sell at a loss. But from this experiment, there doesn't seem to be too much evidence of that. What we do also see in this experiment is you can see that the points are quite clustered towards the end, towards the bottom, which is to say a lot of people are unwilling to either buy or sell. A lot of people are unwilling to either buy or sell. So the question is, is it a tendency to do nothing, right? Is it a tendency to do nothing? So this is from Dilbert. Dilbert it has a lot of very interesting strips that is very relevant to behavioral economics. So this one, if I quit, I will lose some uninvested stock. That's why I'm willing to suffer my job. And normal brain irrationally put more weight on a small loss than a huge opportunity. Now that you explain it, now you're just stupid. So is that what people are doing, right? Is that what people are doing? Right? Are they simply unwilling to sell the stock and just compensate from somewhere else? Okay, so now back to the story that you only experience gain and losses when you actually sell your stocks. So if gain loss is only over realized profit and not profit on paper, you would expect a burst of utility at trade, right? So if the stock is just sitting in your bank account, you don't feel anything particular. But the moment you trade, you should feel a burst of utility. And you expect the burst to be larger when gain loss is higher, right? Because when you trade at a large gain, you have a lot of happiness you earn. And if you trade a large loss, you feel a great sense of loss. Can we observe that? In microeconomics, especially in the Hong Kong's variety, in the particularly the AO variety, the A-levels variety, we have always emphasized that utility is something that economists invented to explain behavior. It doesn't actually exist in people's brains. Neuro Economics provides us with a new way of observing what people have in mind. So, Neuro Economics is the combination of neuroscience with economics. And in particular, usually at this moment, what it means is the use of fMRI to monitor brain activity when subjects make decisions. Have anyone actually been into an fMRI? In Hong Kong, we don't really run this kind of experiments. But when I was in the States, then I have actually been in one of these experiments. Basically, fMRI is exactly what you see in the pictures. Let's see if I have one. I have a picture here. Okay, so right. So bursts of utility would correspond to an increase in brain activity of a specific region. So that's the idea. So let me explain more in a moment. Okay, this is an fMRI. It's like a donut. It's like a donut with a hole in the middle. You lie flat, and then the machine would like push you inside, and it surrounds your head. It's a very small space inside. So typically, what they have is they would have a screen. They have an LCD screen in front of you, like here. So you can see the instructions of the experiment, and they will usually give you a joystick or something that you can click to make decisions, right? So you're lying flat for an hour playing games. Okay. Well, at least usually you get paid more in these kind of experiments versus the ones that you sit in a computer lab, right? So what fMRI measure is brain activity as measured by change in blood flow, right? Change in blood flow. So it really, what it's measuring is blood flow. Right? I think that's probably because there is iron in your blood cells. So when your blood flow increase, the concentration of iron increase. So that's why the magnetic resonance imaging can detect your blood flow, right? Because you have more iron, then you have a stronger magnetic reaction. I believe that's the way it works. Okay. So that's how the experiments run. All right. So this is very interesting because this paper using neuro data to test a theory of investor behavior, an application to realization utility. It's actually, so it's very neuroscience, but it's published in Journal of Finance. You can't see it here, but one of the co-authors is Barbers. So the one that talk about this realization utility we just mentioned. All right, so it looks at certain areas in the brain. So one is called the VMPFC. So that's right behind the nose bridge, right? So you know the brain is like here, and right behind your nose bridge, there's the VMPFC area. So that's the area lighting up in the diagram. So based on existing neuroscience research, this signals value of options. So it's kind of weighting different options. When you're thinking about different options, then this area should light up. Okay. So remember, we are measuring blood flow. Okay. So usually these diagrams, you have these kind of diagrams. So when they light up, then means there's increase in blood flow. All right. So the vertical axis is the proportion of gain realized. So this is, once again, PGR. Okay? Right? And this one, okay, that's the horizontal axis is VMPFC beta on capital gain. All right. First, I have to explain is that the measure of blood flow is not a very precise measurement. Okay, it's not a very precise. So it's not very precise. You can imagine blood flow is not something like, it's not constant, right? It goes up and down, moving around. So typically, what you're seeing in this study is that they have to actually use regressions and some statistical adjustment to get essentially what is an average, right? Because blood flow is not constant, right? And you also have different areas, right? This is not one area. This is like a whole area. This is not one point. This is a whole area. So you need to basically get in some sort of an average to get an idea what's the blood flow to that area, right? So that by itself, so you will see that, so there's some randomness involved. Each blue dot is an individual. You can see that the variance is quite high. So the rate of blood flow is quite high. So, but there is a positive relationship. There is a positive relationship, meaning that the larger the gain realized, the more blood flow you see in this area. Now there's another area they look at, the VST, which is at the center of the brain, and it signals change in expected utility, right? It just so happens that there's an area for that. Right. So this is the second diagram, right? This is the second diagram. The first diagram just now is the area that signals the valuing option. So it's sensitive to gain and losses. So the bigger the gain, the more blood. VST. The VST signals the change in the expected utility. Once again, this is based on past research. And once again, the dots have very high variance. You especially see some outliers that are ridiculously high compared to the average. Well, so the vertical axis once again is this is proportion of losses realized. So this is in the loss domain. And what do you see? Once again, there's a positive relationship between the loss realized and the increase in blood flow. Right. Increase in blood flow. All right. So So oh, I see. This is two. Both are P. Actually, these are both. Yeah, we're still at this point. So I mismatched the bullet points. So these two are actually still VMPFC. So these are all still gain and losses realized. So more blood flow when there's big gain, and more blood flow when there's a big loss. Okay, more blood flow when there's a big gain, more blood flow when there's a big loss. There should be one more diagram. There's one more. Yes, this one. This is really the one. This is really the one that has to do with realization utility. Is that at the moment of trading. Now, so once again, so this time around, the vertical axis. The vertical axis is blood flow. So because in these two diagrams, the horizontal axis represents blood flow. In this diagram, vertical axis represents blood flow. Horizontal axis represents time in seconds. Time in seconds, right? And I believe these are fraction of a second. Okay, so fraction of a second, right? Vertical axis is blood flow, and in the 0 point is the moment of trade. The moment they actually the moment they actually execute an instruction to sell. Okay. The blue line represents selling at a gain. Actually, the resolution is so low. I would have to check. Let's see if I can figure it out. Yes. Okay. Yes. Okay. Yeah. Apparently, it's this screen resolution is relatively low. All right. The blue line is actually selling at a gain. So the red line is actually pressing the button to hold. So remember, this is the game. The way it works is you're looking at a screen and you have like a joystick to control. So you have to press the button deciding whether you want to sell, or press another button to decide whether you want to hold the stocks to proceed. Okay, so that's how it works. So the blue line is pressing the button for selling. The red line is pressing the button for holding. Okay. So and obviously what's so exciting is the blue line is higher than the red line. That is to say, when people press the button to sell, they experience a large burst in blood flow relatively to when they press the button to hold. And this comes right after they press the button. So this is interpreted as evidence that they're experiencing realization utility. When you hold your stock, you have paper gain. So you don't really care that much. When you actually sell, you actually get an extra burst of utility, which is represented by the increase in blood flow. Okay. So this difference is interpreted as evidence supporting that people experience gain and losses when they trade. Okay. So this is the forefront of economics research, right? Behavioral economics research right now. This paper is forthcoming in 2014, so it's very new. It's a very new paper, right? Now, it's not saying that you can't have alternative interpretation, right? There's always one possibility is, for example, are people simply paying more attention when they are pressing the trade button versus when they're trading the hold button, right? If you can think about it, if you don't care, you just want to get through the experiment, and you don't really care about how much you earn, you can just keep pressing the hold button, right? You can keep pressing the hold button, and since you're not really paying attention, then naturally the amount of blood flow to the area that has to do with expected utility would be relatively low. You're not really paying attention. So that would have to be figured out perhaps in future research. The fact that they have increased in blood flow probably still signal that they have done some calculations, right? You're at least paying some attention. You're not completely like flat, not doing anything. But whether you can easily say that this is truly a gain utility, that would probably remains unclear. Right. I think